Hello students, today's lesson is going to be covering the differences between a breakup structure versus stop hunts or equal high liquidity sweeps. So over these lessons, we've been learning about how the market can move and stop your trades from going the way that you intended for it because they ended up going the opposite way, and then a couple hours later, to your surprise, you see them literally falling back into the intended direction. And then at the same time, you are probably trying to figure out the difference between that and when a trend breaks structure to signal a reversal, right? So let's take a look at the charts real quick. In this case, we are looking at USD 30, aka the Dow Jones. So here's an example of price showing us that it is ready to continue higher to create higher highs. You have price from this peak here, dropped, broke the structure, being this whole entire structure right here, pulled back for the lower high, boom, lower low, still within this area that they bounced from, right? So when you're looking at it, this right here, as they continue to create lower highs and lower lows within this range, they stopped right here. Stay with me now. But when you're looking at this structure right here, we can see that price significantly broke above, returned back to the zone of demand, and typically this significant break of structure is what's able to let me know that price is indeed, after it returns back to the zone, going to push to create higher highs and breaking previous structures where there might have been stop losses above. So notice price significantly broke above that structure. And it just didn't happen with wicks, and they went significantly higher than this price and the lower highs and the lower lows. This is a confirmation for break of structure for profit potential, right? But as opposed to a situation where price stop hunted you and still went into the intended direction, that right there is a different thing, okay? Because it's going to be presented like this. Observe. As you can see, 3:30 was around the time where the New York session was happening. As price crossed over, even up to 7 p.m., we can see that price was literally trading around this zone, right? What does price do? Price goes slightly above that range and rejects and falls right back into the intended area that you might have thought. That right there is a liquidity sweep. We can see that the relationship between the equal highs and how they deliberately went slightly above, where we can see mentally that you would have placed stop losses just above here, and after they do that, they take all the stop losses out within that range, then they go down that way. That's the difference, right? One of them is deliberately showing that in a downtrend, they broke above, returned back to create higher highs, or in an uptrend, that's going to turn into like a downtrend. That's how you're going to see it. So let's find another example. You will see it all over, right? Notice in a zone like this, right? We can see that price is trading up in these highs. Boom, boom, boom. But look what happens right when the New York session comes in. they go above that range, right? Boom, boom, boom. All right, they go above that range, almost as if they went to stab that zone, right? Left some wicks, dropped, pulled back, and what are we expecting? At this rate, we already know what just happened here. We are expecting sells because this is another example of a liquidity sweep. Price grabs liquidity, aka the orders where there were several stop losses, and that's where money is. If I was creating a game and I wanted to know exactly where to trap you, I would put the market in a zone where we all were trained to put our stop loss above that range. So it is obvious to the market maker why they create price action in that manner, so that way they too can grab liquidity before they head their way down. Savages, right? And that's what I'm trying to explain to you guys, the difference between a break of structure to signal a trend change versus equal highs that are created to take us out. Here's another example. We can see that ever since New York session, price was trading here. Outside of New York session, price goes above that zone, right? Clearly, there was already a trend. Price came from this area, broke above, pulled back, continued, and so on and so forth. That also is another reason why price can move the way it does. Higher highs and higher lows. Okay? That's why oftentimes you'll see price consolidate in a zone like this, because it creates the illusion that price might be falling back in here, or the breakout traders are waiting for price to break out. So then either there are stop losses here and here, which is why you'll see price behaves in the manner that it does. So let's get back over here. As you can see, price moves back and forth, and these are equal highs where you would want to put your stop loss up here. So what do? Huge aggressive candle, like a bull shark, jumps out of that zone, and what happens next? Then price falls down. Or in this area right here, price was trading here back and forth. We can see that there was an order block that started this whole move. And then what happened? When price went all the way down here, because there had to be some stop losses below here as well for those people who are holding this trade for all of these pips that it was accumulating to the upside. So that is how you're able to identify a liquidity sweep versus price breaking above to create higher highs or lower highs and lower lows. All right, because in the sequence of a downtrend, you'll see price creates a zone, drops, pulls back, lower high, lower low, lower high, lower low. So then when price significantly has a whole bunch of candles breaking above, then pulled back, that is the confirmation you're looking for to determine if price is just creating higher highs and higher lows. All right, as opposed to this right here. Let's turn this off. Let's remove this. As you can see, it's the same scenario. Price was trading at above this area, or it was trading at around this range. And what do you see? Right when the New York session starts, price goes above and falls right back in here. So it's just like I said, it's almost as if the bull shark jumps out of the water just to take out, the swimmers or, the surfers, whatever the case is, if you want to graphically think about it. And then what happens next? Once they take out possible sell stop losses that were up here, then they fall right back down. And it's beautiful because as they do that, sometimes they create imbalance, which is why, like, when they pull back to the zone and they do not trade above that previous sweep, then guess what? That becomes your opportunity after you've seen all this evidence and you were following up with the reasons as to why they behaved that way. You can take your sell, put your stop loss above that previous murderous, heinous crime of stop hunting, and you can take it back down. That, ladies and gentlemen, is the difference between a change in trend and a liquidity sweep. All right, let's go ahead and find another pair. Let's go ahead and go for AUD USD. All right, so whenever you see price trading just slightly above a range or slightly below a range, and then they make um, a reversal pattern right above it, then that's typically a sign that you are um, witnessing a liquidity sweep, which could translate into a reversal pretty soon. So look at that. As you guys can see, this was an M formation. We all recognize it as such, happening right in the Asian session. What did they do? As everybody's getting comfortable waiting for price to fall, what do? They go up above the zone, create an M above that, and then they drop. That's a liquidity sweep, ladies and gentlemen. It's a very tactical way of taking out stop losses. So what do? You wait for them to create that reversal pattern, put your stop loss above that, and then expect the drop. Same thing for the opposite. Let's see if we can find something for Euro USD. Right. So look out for your equal highs and lows. Try and see how they behave off of that. And if they're reversing, you take that trade. You counter trade. Okay? The worst thing that can happen is your stop loss gets hit. Here's another situation. Price was trading around here. You can see they went above it and dropped. Went above it again and dropped. So these are vicious moves, but if you understand the behavior, then you'll be able to survive and not just be blind to what's going on. All right, so here it is again. Price was trading nicely above this area, or they were consolidating since the Asia London sessions of the 23rd of February, and then boom, price goes slightly above it, pulls down, returns. There's your opportunity, expecting to sell. All right. Same thing over here. Who would have taken this trade expecting price to bounce again here for a W formation? I would have. I'll be honest. And then price goes down slightly below, pushes back above, retraces, then there goes your buy. This was a very low liquidity area. There was not too much going on, but as you can see, that happens a lot. Let's go to gold real quick. And typically, I'll tell you guys this. You will notice this tendency happens outside of New York, and the relationship between the Asian session and the London session is lethal because they will typically hold a zone and consolidate and bounce between those areas. And when you see them go right below that area and stab it with a wick, you know what's going on. You know what's going on. They're coming for those stop losses. And once they do that, and you understand what's going on, you take that counter, you put the stop loss below the liquidity sweep, and then you take the buy. This is exactly why price also went up this way. So then they took out stop losses both ways. And that's what you're seeing here. All right, it happens a lot. So my advice to you is be patient. Wait it out. See how they behave and then attack. Here's another one. Equal highs. It goes slightly above it, sometimes to go retest a previous area of supply. And then they fall right back in. I think I saw something like that for USD CAD. Let's see if we can find that. I hope this is making sense to you guys. And at the same time, really giving you a different perspective of how the market makers create price action. USD CAD, there we go. Okay, so there it is. As price was trading right here, expecting price to drop, a push. This time this was because of news, but news came with manipulation. So as you can see, price literally just went up in that zone just to grab the money, take you out, and typically I'm telling you, this happens with wicks lots of times, right? All these equal highs, you're seeing the sell and you're taking it, and then boom, price goes above, boom, takes out liquidity again, and drops back. It's all an algorithm. Price reacts and gravitates towards where orders have stop losses. So once they get their mission accomplished, then they will go right back into the direction that they were intending to go. So really keep your eyes open for these situations because they will definitely help give you an edge, right? Look at, now you know why price does what it does. You see how price was bouncing here in this demand zone? Now you understand why they went down below and then went back up. Now you know. And these are the differences between a liquidity sweep and price giving you a change in trend, right? Sometimes they can do this and mix the two, so you have to really be on your P's and Q's. For instance, look at this. Price created a higher high, higher low, higher high, higher low, returned back to the zone here, and then stop loss could have been placed below the range, and yes, they went for about 63 pips. It got to the range that they wanted. In this case, it was here. But they fell right back in the zone just to take out liquidity. So now that you know better, keep your eyes open. I'll see you next time.